Hello friends. Welcome back to our trading channel, Currency Watchtower. Today's video is going to be our first video of our Smart Money Concept series, in which we will learn about fair value gaps, which we also call FG, imbalance, or efficiency. Secondly, we will learn about order blocks, which we also call OB. In this video, we will learn about fair value gaps and order blocks, what fair value gaps and order blocks are, and how to identify them. If you want to learn to trade in a true and accurate way based on the smart money concept, then you have to watch the video till the end while understanding it carefully and do not skip the video at all. In this video, whatever I teach you, friends, I am also going to demonstrate it through live trading at the end of the video. So, you must watch the video till the end to understand everything very well. So, let's start the video. Give a like to the video, and if you are new to this channel, subscribe to the channel and also set the bell notification to all so that you receive all the notifications of the upcoming videos on the smart money concept on time. Before knowing what fair value gaps and order blocks are, I would like to highlight a common mistake made by retail traders during trending markets, which often causes them to suffer losses. Retail traders see that when the market is moving in an uptrend or downtrend, for example, suppose the market is going uptrend, forming higher highs and higher lows. Now, retail traders want to enter, so they start waiting for the market to break the higher high before taking a buy trade. After that, when the market breaks this higher high point, seeing the breakout, thousands of retail traders start buying and place their stop loss somewhere nearby. Afterward, the price moves up slightly and then comes down. At this point, all the retail traders who bought at the breakout have their stop loss orders hit. This is why we should not enter in the middle like this, otherwise our stop loss will be hit most of the time. Now, how do we trade such pullbacks? When you understand fair value gaps and order blocks in this video, you will also learn how to trade pullbacks correctly. So, let's understand everything step by step. Let's first start with fair value gap. What are fair value gaps? Friends, when the market moves upside or downside with strong momentum, we see gaps forming between three candles, which we call fair value gaps. We also refer to fair value gaps as imbalance or efficiency, so don't get confused. Whenever we see strong momentum in the market, it means that smart money is evolving in the market. Whenever fair value gaps or imbalance form in the market most of the time comes back to fill that fair value gap. As you can see in this chart, this is our bullish chart, and here the market is trending upwards and is at its higher level. Now, to find the fair value gap in the bullish direction, you simply have to mark the high of the last red candle formed during the pullback. As you can see here, the market has moved up from this point and then pulled back. Now, the last red candle in this pullback is this one. So, first, we need to mark the high of this candle. After that, we do not need to do anything with the second candle. Next, we mark the low of the third candle. Now, you can see that when we mark the high of the last red candle and the low of the third candle, a gap is formed here. This is the gap that we call the fair value gap, imbalance, or efficiency. We call this gap a fair value gap because the market has moved up aggressively from here. When there is such strong momentum in the market, it is driven by smart money, that is, a large amount of capital has been added to the market during this period. This is why we see such strong momentum, because only smart money injects a large amount into the market. I have explained this to you. friends, very well in part 1 of the Smart Money Concept video. So now we have marked a fair value gap here. In the same way, you need to identify the second fair value gap and mark the low of the third candle. Now, as you can see, when we mark the high of this candle and the low of the third candle, we see a gap being created, meaning that another fair value gap is formed here. Similarly, to find more fair value gaps, you have to mark the high of the next candle, this one. After that, do nothing with the second candle and mark the low of the third candle. Again, you can see that when we mark the high of this candle and the low of the third candle, another fair value gap is created. So, in the same way, you also have to mark the fair value gap. That means that in a trending market, when you first mark the high of the last red candle and the low of the third candle, the gap that is created will be our fair value gap. Similarly, to find the second fair value gap, you have to mark the high of the next candle. After the candle, do nothing with the second candle and mark the low of the third one. The gap that is created is the fair value gap. In this chart, we can see 3 fair value gaps. Whenever the market gives a pullback here, there is a high chance that the market will come to fill this first fair value gap because our first fair value gap is at the alt point. The probability of the market filling this fair value gap is very high. If these 2 fair value gaps were not here, the market would have reached this level, filled the gap, and then moved upward. However, since 3 fair value gaps have formed, there is a higher chance of the market reaching this level. As you can see, the market has given a pullback here, reached the earlier fair value gap, filled it, and then moved upward. I hope that now you understand how to find the fair value gap in a trending market and how to plan entries accordingly. In this video, you will also learn how to do this in practice. Now, let us learn how to identify the fair value gap in a downtrend market. Friends, to find the fair value gap in a downtrend market, you simply need to reverse the technique used for an uptrend market. In an uptrend market, to find the fair value gap, we mark the high of the last red candle and the low of the third candle. But in a downtrend market, to find the fair value gap, we mark the low of the last green candle and the high of the third candle. As you can see in this second chart, the market has moved into a bearish trend, given a pullback, and then continued downward, breaking this lower low point. Now, to find the fair value gap, you have to mark the low of the last green candle. After that, do nothing with the second candle and mark the high of the third candle. Now, here you can see that when we mark the low of the first candle and the high of the third candle, we do not see any gap being created because the high of the third candle has met the low of the first candle. That is, the high of the third candle is above the low of this green candle and no gap is created here. When the low of the first candle and the high of the third candle meet in this way and no gap is created, we call it mitigation. In a downtrend market, a fair value gap is created only when the high of the third candle is below the low of the first candle. So here, no gap is created between the low of the first candle and the high of the third candle. Now we will take the next candle. We have to mark the low of this candle in this way. After this, the second candle has nothing to do and the high of the third candle has to be marked like this. Now, you can see that when we mark the low of this candle and the high of the third candle, we do not see any fair value gap being created here either because the low of this candle and the high of the third candle have been eliminated. So now we have to mark the low of this candle. After that, the second candle has nothing to do and the high of this third candle has to be marked. Now you can see that a fair value gap is formed here. So we have found a fair value gap. To determine whether there is any fair fair value gap in the future, we will now mark the low of the next candle and the high of the third candle. Here, you can see that another fair value gap is created, meaning that during this momentum, two fair value gaps have been created. So here our ultimate fair value gap is the first one. If the market gives a pullback here, then there is a very high chance of the market reaching this first point. If this first fair value gap was not there, then the market would have reached this fair value gap and reversed after filling it. But since there are two fair value gaps, the market can reach this ultimate point. Now, you can see that the market has given a pullback, reached this first imbalance, reversed from there, and then continued downward. Friends, you have to remember that any fair value gap, whether small or big, will most of the time be filled first by the market. I hope you now understand well how to find the fair value gap in a downtrend market. Friends, if you find the video interesting and are understanding everything well, then please like the video and subscribe to the channel. We completely understand that the fair value gap works best alongside the order block. After this, we will analyze the fair value gap by combining it with the order block, and we will understand it with a live trade example. Friends, order blocks are mainly of two types. 1. Bullish order block. 2. Bearish order block. We call the bullish order block the one from which the market moves upward, and we call the bearish order block the one from which the market moves downward. Let us now understand this exactly. Friends, when the price moves upward with strong momentum from a particular point, to mark the bullish order block, you have to mark the last bearish candle before the buying momentum. That is, the last red candle before the market moved upward. For example, suppose the price has come here, reversed from this point, and moved upward. The red candle formed just before our buying momentum is this candle. When we mark it in this way, combining its high and low, we call it the bullish order block. This order block acts as strong support and resistance. Whenever the price reaches this order block, the chance of a price reversal is very high. If there is a fair value gap near it, then its accuracy increases even more. This happens because the price goes to fill its fair value gap, and if there is also an order block near it, then that order block starts rejecting the price from there. As I just told you, the order block works like strong support and resistance. I have also mentioned many times that at the support level, there are a lot of buyers active, and at the resistance level, there are a lot of sellers active. So here, this bullish order block is working like a support level, and there is also a fair value gap here. Now see, when the price comes here to fill this fair value gap, many buyers who are active here start buying, increasing the demand, which causes the price to move upward from here. Now see, the price pulls back here again. There is an order block here, and just near it, there is also a fair value gap. So, when the price pulls back, it reverses after filling this fair value gap and moves upward. Now look at this chart. This chart shows our bearish direction. To find the order block in a bearish trend, we have to mark the last green candle before the selling momentum. That is, the last green candle before the market moved downward is called a bearish order block. Here, you can see that the market has moved downward, given a pullback, and then continued downward, breaking this lower low. Now, to find the order block, you have to mark the last green candle before the selling momentum. Here, the last green candle before our selling momentum is this one. So, you have to mark the high and low of this candle. When we mark its high and low, it becomes our bearish order block. The bearish order block acts as a strong resistance level because there are a lot of sellers active here. If there is a fair value gap near this order block, then there is a high chance of the price reversing from there, because whenever the price comes to fill the fair value gap near this order block, the sellers who are active at this order block start selling, increasing the supply, causing the price to move downward from here. So here, you can see that we have marked an order block. When we mark the low of this red candle and the high of this third candle, we can see a fair value gap being created. That is, there is an order block here and there is also a fair value gap. Now see, when the price comes here to fill this fair value gap, all the sellers active at this order block start selling, increasing the supply, and you can see that the price starts moving downward from here. So, in this condition, you have to trade carefully. When there is an order block and a fair value gap near it, you should wait until the price fills that fair value gap. If any reversal candlestick pattern is seen, you can then plan your trade. Friends, one thing you must always remember is that the closer the fair value gap is to the order block, the higher the chance of the price reversing from there. You should also never use this setup in a sideways market. Friends, using this setup, I traded Bank Nifty. Let's take a look. Look at this chart. This chart shows our Bank Nifty on a 5-minute time frame. Here, you can see that the market is in a downtrend and is currently pulling back. If you look at the order block, you will see that our order block is this green candle. We are marking the order block here. When we marked the low of this red candle and the high of this third candle, we found a fair value gap just near this order block. Now see, when the price moves here, high rejection is seen in the price, causing a red candle to form. At this time, I was waiting. When this red candle was completely formed and the next red candle started forming, breaking the low of the previous candle, I entered my trade. Price then moved downward, and my target of 90 points was achieved very easily. So, just as I have explained, you must trade by following the proper rules. You should always be patient, never trade in a hurry. First, wait for your setup to form in the market. Only when your setup is confirmed should you trade. I hope you now have a clear understanding of fair value gaps and order blocks. If you liked the video, please like the video, subscribe to the channel, and share this video with your friends. If you have any doubts, please let us know in the comments. Also, if you haven't seen part 2 and part 3 of the smart money concept, please watch them as well, because all my videos on the smart money concept are interconnected. With that, we will meet again in another new video on the smart money concept.